I think the most important thing we learned is that, yes, there was a split in terms of the exact size of the cut. There were differences of the view on terms of where the neutral rates are. But as you said, we know all of that. I think the most important thing was, I think a broad range of the participants, I think a major group of them had more confidence that inflation is coming down to a more sustainable level. That's certainly a confidence that I share. That's a confidence that our team shares. I think, and that's important in providing an anchor given how much market pricing has swung about in the last few weeks.
Okay, that's great. But I guess the big question for Jan, for you, for everyone over at Goldman's and elsewhere is, okay, that's great, but the numbers on jobs last week, whether it's JOLTS, initial jobless claim, or it's ADP especially, and of course the payroll, they're all pretty solid stuff as well. So I get it, inflation moderating, so we don't need to have a higher interest rate with inflation moderating that actually gets more hawkish by staying the same. Let's cut. But have we gone too far in our expectations of the cutting cycle, both on the rate watch and, dare I say it, at the dot plot as well?
I think certainly the context for this inflation number has changed because of the jobs report that you mentioned, right? So I think that generally I feel like the stakes going into the CPI report are lower than they were earlier in the year. But it is true that given that very strong jobs numbers and a string of strong data, I think the market is going to be a bit more nervous going into this CPI report, and we are expecting something on the high side of consensus. But the bottom line here is still the case that, I think the bar for not moving, I think, is very high. I think 25 basis points, which is our expectations, which is, more or less the market's expectations, a bit less than that, I think is still the right expectation going into November.
I want to pick up on those nerves because it's been noted that there's volatility in the Treasury market. And I saw one comment saying, look, we are lurching from one narrative to the next. What do you make of what we're witnessing in the 10-year and just how much more volatility the bond market can weather from here?
Look, I think that, again, given the news we had on the jobs front, I think there is a risk that, if we get a firmer inflation number today than market expectations, that I think you could extend some of that swing in narrative that you have seen from concerns about recession but a month and a half ago towards concerns around, no landing or, even potentially skipping a November cut that has taken hold in the markets. I think, again, the thing to hold on to, the anchor here is inflation is coming down. I think Fed officials have greater confidence in that, and that is going to play out over a number of months. And along that side, I think interest rates are going to come down closer to a more neutral level.
To me, one interesting commentary was around the use of a jumbo-sized rate reduction, that the Fed feels like it's one of its weapons or tools that they can use now without spooking the market. So what does that mean in terms of just how jumpy we could be if we get some data that is especially weak, for instance? That's not the narrative now, but if that happened to occur in this cycle, that we could be straight back at a 50 basis point move all of a sudden just overnight.
And I think that is part of what is keeping rate volatility elevated somewhat. I think it's part of what is keeping a negative skew on the dollar as well. That I think that given that you're starting from a level of rates which is, reasonably high relative to what most people's expectations of neutral is, the Fed can and have shown they can react in a quite a big step to downside shocks. So I think that is part of the arsenal going forward.